Hi everyone, this is the 21st of July 2018. I'm going to spend today some time discussing this chart and the intermarket relationship because I think it often gets misunderstood. I had an interesting discussion yesterday with an institutional sales on the very same topic, and I think I addressed it many times last year, but it still continues to come up. And the reason it does is the misunderstanding on the underlying factors that drive currency moves. I think if you go purely by textbook, if you think about things like purchasing power parity and interest rate theory, a lot of it is based on the past, which means that when you were on a fixed rate environment, a lot of those pressures built up over a period of time because changes to currency rates were made not on a daily demand and supply basis, but on an ongoing basis as and when the governments felt it needed, and therefore that created a huge underlying pressure in the system, and there were huge reactions at the time devaluations were actually announced, because then they had to reset to the new stage, and so the calculations then would be based on things like interest rate and other parities in terms of knowing where the real value of the currency was. But now you have a daily reset every day. So the greatest innovation of our time, I believe, is free floating currencies. Of course, it may all have been driven by the rise of the dollar as the reserve currency, but the introduction of free float is what has allowed our credit cycle to extend for this long, because it's one of the big innovations. And the reason it does that is that in a free float environment, the currency rate on a daily basis reflects flows on the basis of either trade or capital, and therefore this adjustment is not always directly based on the theory of interest rate parity or purchasing power parity, because it can be supplemented by other forces. So say for example in India, where typically the currency weakens over a period of time, you had long periods of now stable currencies throughout 2003, 2008, and also the last couple of years since we hit 69. We've been below that mark for almost 4 years now, more than 4 years. So in fact, this would be the 5th year going on. We would be completing by September. And the reason that's possible is that you can always supplant the other pressures with capital flows, and therefore that takes care of the underlying value pressures that exist in any currency pair. And it also allows for an ongoing hedging of risk, and so it changes the market completely. What happened in the last 2 days, a lot of, I think, announcements and discussions around announcements that were made by Donald Trump as to first that he wouldn't really like interest rates to be higher, and you saw bond yields which were rising 2 days ago to actually pulled back a bit, not any major sharp reversal. And I've been writing, I think, most of this week about the start of the next wave in bond yields. So after a gap, I started writing again about the 2-year, 30-year, and that they'd probably corrected, and the 30-year gave the clearest indication of that. But you got that one-day pullback, and then yesterday there were comments from him which were read into by the market as him wanting a weaker dollar, and the dollar actually sold off after what is a 3-wave advance, which is what we were expecting. I think a 3-wave move up completing an ending pattern, unless it broke past 95.5, which would change the structure into something else. And also after this ending pattern, if you do get a correction that is corrective, then maybe you expect one more move up in the dollar later down the line, else you would peak here is what, and that's what I said in, I think, the face interview that I'd been sharing on YouTube. It's still there. That YouTube interview with Forex Analytics, I explained, I think, the first half this dollar view as to the two alternate scenarios that could develop, and why at 95.5, if you didn't get past that, you could also sell off. So I've been open to both scenarios. I would still give it a day or two to see what happens, because an event-based move like based on announcements yesterday can often be misleading indicators. But that said, what happened yesterday is when the dollar sold off, you also got bond yields moving back up, and the biggest move actually in the 30 year. So it went back above the 3% mark and closed somewhere close to around 3.02 or above that. And so it was a big move in the 30-year bond, which is one of the charts I'm showing here, and the second is the dollar. So what I was trying to explain, I think in my podcast last year, was that when the dollar was actually falling or was in a bear market, which is what I think it is since 2017, and what you're seeing is a counter trend move up, which is either over or it extends for a while. That's the part I'm trying to figure out, but eventually the next third wave down for the dollar would resume, and that falling dollar puts pressure on flows into US assets. And a large part of the US rally when the dollar was rising from 2014 all the way into 2016 was on the back of the rising dollar, was money moving off or out of other risk areas, whether it was emerging markets, commodity based countries, currencies, the Greek crisis, a lot of money over the years, and even China. A lot of Chinese money has been reported to flow into US real estate and Canadian real estate and so on, and so a lot of the equity, debt and real estate markets were pumped up by the dollar. So what happens when the dollar starts to fall? Well, if the fall is small, it might just get adjusted, or you could very well be hedged for it. But if you get a steep enough decline, then it actually would lead to a reversal in flows from at least bonds, then equities, and maybe real estate. So that's the broad picture. We did not see a big reversal in equities, but what I show you on this chart is at least that the bond market in the medium term is highly correlated to those movements in the dollar. So this is not the bond yield, this is the bond price, which means when the price goes up, yields actually go down. And what you see is medium term correlation, which is extremely positive, which means that when the dollar goes up, bonds are also going up, which means yields are going down. Now that might sound counterintuitive based on not just theory, but how a lot of media still continues to report these trends, saying that the dollar is going up because interest rates are high and therefore it attracts capital. But what if interest rates keep rising and bond prices keep falling? What are you really buying? You're really buying bonds in terms of their price, not the yield, not the return, unless you're holding to maturity. And if you're really buying the bonds in the near term, you would end up losing money on those bonds. And so would you really buy bonds that are falling in price? And so, which is why the medium term trend appears to be directly correlated, that when the dollar is falling, the demand for US bonds actually goes down and the yields actually go up, which is exactly the opposite of what is reported. And one of the reasons it gets reported that way, and so I'll now have to move my cursor around, one of the reasons it gets reported that way is in the very, very short term. While broadly speaking here you see this is a falling bond and dollar market, in the short term, while that is happening, here when this part of the dip in the dollar actually took place, you had yields actually go sideways or even appear to move up a little bit. And so that's the argument that you actually hear in the media. And there are also lead lag effects, which means while broadly these are both rising, this top occurs much before this top by many months, and when yields here start rising, this rise in the dollar gets related to rising yields, and therefore that's how it is reported by media. And also a lot of analysts who give their opinion on dollar and bonds based on rising yields will lead to a rising dollar. Absolutely no evidence when you look at it on a monthly chart, which is what this is, and try to look at multi-month trends or multi-quarter trends, then you get a completely different picture. On and on, again and again, you'll find, except for lead lags between the two, both have moved up, then again down together. Again you have this spike up initially in the dollar, then in bond prices, and after that the dollar is falling, then bond prices are also falling, and so on and so forth. So this entire period here where bond yields were going up, the dollar was flat. But what happened between 2012, 13, 14, while the dollar was flat, is that many currencies, and especially ones like Brazil or India, which had foreign borrowing related issues because of their high levels of external debt, and in India's case maybe corporate debt which was rolling over, bond yields actually shot up, and you had a bond market spike as far as the yields are concerned. And so even though the dollar was doing nothing, the rising yields pushed currencies down against the dollar, which means the dollar was strengthening even though the dollar index itself was not doing so much. This is very important to understand because over the last year now we are in an environment where interest rates in the US are going up and bond yields are rising, and that is the rising yields in the US is essentially pushing up yields almost everywhere, because that's how money has moved from a high yield market, from a low yield market to a high yield market, because that's where the borrowing takes place in the currency that has lower interest rates, and then it gets deployed into markets that have higher rates, and that goes on till the point where currency risk becomes an issue, or when bond yields start rising, causing bond prices to fall, and so bond markets themselves become an issue. So whenever those two issues show up, flows towards those currencies slow down or stop, and then the currencies start to fall. And that's what you witnessed, I think, in the early part of this year. We've seen many emerging market currencies actually spill over because of bond exposures, wherever they had a lot of foreign money in their debt, whether it was Turkey, Brazil, all their bond markets and currency markets actually sold off, and that pressure has a direct impact on other markets. Like our currency too is weakening because of the general currency adjustment happening. And the real issue though is what you saw last night is both the dollar and the 30-year bond both moved down together again, and so that's what is not I think being reported exactly like that, and my sense is that's what is going to be the trend. So the next leg down, so you see this very short term period where the dollar actually riding, this is essentially the period where bond yields have not been rising anymore recently. They peaked and then they paused simply because the dollar started to rise, showing some kind of strength, and if the dollar did continue to rise further beyond 95.50, it could have provided further easing to the bond market itself. But bond yields themselves are not showing any respite. They're showing a sense that they're going to fall, and they might really be the lead indicator for the dollar rather than the other way around, because a lot of money is the bond market is far bigger than other markets, and if flows to the US bond market and to various other bond markets that are interlinked slow down, then various bond markets start to fall, interest rates start to go up, and the most direct impact is on all the currencies, which means that first of all, as flows to US bonds slow or even turn negative, it would have a direct bearing on the dollar in terms of the dollar actually going down. And simultaneously, because the rising yields in the US push up yields in other places including India, the emerging market and other currency pairs also weaken against the dollar. So you have this deviation, which is what I've been saying I think for a year, and you don't always see it except for very short periods of time, but I think it may become more apparent once the third wave in the dollar down starts, whenever that happens, is that emerging market and various currency pairs that have debt exposures would actually weaken against the dollar, even while the dollar index is weakening against the pairs which are inside the dollar index, because the dollar index essentially doesn't include many of those countries, the emerging pairs. It's mostly the euro, pound, yen, and so on, and those countries have different currency trends for the very reason that one of the policies that we've seen followed for the last decade is the lead lag in actual credit action. By that I mean is that when the US was doing quantitative easing, Europe, Japan and others were actually not doing so. So all of them do not seem to act simultaneously. They act with a lead lag effect. One of them takes actions first, the next one next, and the next one next. You can see that throughout the dollar rally of 2014-15, it was initially the yen, and then once the yen weakened significantly, later it became the euro, and then each of them started to come out with their own easing programs, and that was a time when the US had already started talking about tapering and slowing down. So now you have the US, which has spent more than a year or 2 years trying to raise interest rates. Now it's reversed its QE process, and you still have Europe and Japan running QE programs. So when they reverse, which they're doing with a lag, so this lead lag effect is causing currency markets to move with a lead lag in terms of what they're doing. So many of those pairs were weak because of the intent to weaken the currencies by the quantitative programs, and now when they reverse that course, their currencies actually strengthen against the dollar, which is where the dollar starts to weaken. Whereas the weakening dollar impact, which is related to the bond market, has a very, very different impact on countries that have external debt and whose currencies are related to capital flows. So even where you have large capital flows, whether in your bond market or equity market, their impact on those currency markets is completely different from the developed markets. And so that's the lead lag that you need to keep an eye on all the time. You can't always relate to what happens in the dollar to what is happening in those currency pairs. In fact, one of the effects of that you can see in late stages of the 2008 bear market. So let me just pinpoint the 2007 top for the US market was occurring around October, that's here, and the dollar index was essentially falling, and so in this time period US equities and the dollar both were falling, gold prices were going up, but what was the impact on, say, the INR? The INR started to bottom out during this phase. It stopped strengthening even though the dollar was falling. The INR was not rising against it anymore during the last quarter of 2008, and in fact started to weaken, even though slowly, because the falling dollar does have some impact. We can't say it has none, and that is why the initial rise in the USD-INR pair was very, very small when you had the big sell-off in the first quarter of 2008 over here, because the dollar index was putting downward pressure on the pair. But that despite that, the USD-INR actually did weaken, and Indian equities did also weaken, and the two did not relate as strongly as we always think they should. So that's the multi-layered effect of that. So if you do get a strong a weak dollar environment, which is extremely weak, but you have equities and bonds falling, it's possible that the INR weakness that I'm talking about is actually less magnified than it has been so far. And so far the markets have actually ignored the weakness in the INR, and so you might be in a very different environment where you will see where the INR is not really weakening that much, but equities are. And then again, just like it's not made any sense over the last 2-3 months, it might not even make sense at that point of time, but the pressure on the INR will remain to the downside as long as equity or bond prices are actually falling. And so even though it may not fall much, it may not get too strong as some people are thinking. What we also have in the USD-INR pair is a 5-wave rise from the lows that it had made last year post demonetization, not even demonetization, in early 2018. So all of 2018 the USD-INR has been going up, and so far it is a 5-wave rise, and so the trend is clearly up, and any correction would only be a correction to that trend before it actually resumes. So this is what I wanted to explain. I think it should have given you a fair idea as to why free floating currencies change the way we actually look at the movement in interest rates and currencies, and what is often reported by the media in terms of what it means is based more on these short-term deviations that occur between the bond market and the dollar market, but not really on the bigger trend, and therefore it actually misreports what people start expecting. And that's what it was an interesting discussion I was having with someone yesterday on the same lines. And when I told them, fine, if you think the dollar is weakening, what would you think about bonds? If you're buying bonds, do you think bond prices are going up? Are capital flows going into bonds or out of bonds? And so moment you think about that, it makes sense as to why this relationship is the way it is. If money is flowing into US bonds, then bond prices would actually go down and not up, and if they started to go down, that means the dollar would actually strengthen, which is completely logical. So that's all in this update discussion on a completely macro subject apart from just Nifty. Thank you.